I want to teach the American public how financial planning is going to fail them. Because what they don't realize is that in California, if you retire successfully in California, you're going to be paid sixth in line out of your own money. Sixth. While the banks, the financial institutions, Wall Street, and the IRS, not only are they ahead of you in that line, but they already have their hands in your money before you do.
I can't turn on my phone or my computer without getting a shot across the bow of some spam-ishy kind of, here's another digital marketing agency promising me, I'm going to have 700 people in your Zoom room, and all you have to do is pay me $70 per lead, and I guarantee you millions of dollars. It's like, stop the madness.
$1 can do the function of 4 if we have it in the right place.
Hey, this is Cole from Life 180. Today I have a F2 experience, fun and finance. Those are the only F words I'm going to use to describe my next guest. I won't go into any more F words other than that. Fun and...
Am I held to that same standard?
No, you can swear.
Now?
We would encourage. We have these fancy editors behind us that can put like emojis, fireball emojis over your mouth, and the YouTube algorithm loves a good F-bomb, a good finance bomb. David H. Kinder, Dynamic Advanced Wealth. I met him on a social media platform. We're going to dive into all of that, specifically for whole life insurance. Whole life insurance seems to be taking over the world. It seems to be an asset or a product or a concept. I don't know what the heck you call it anymore these days, but we're going to unpack it.
Yes,
David.
It is all of the above.
Let's go with that. That's your first question. Is it all of the above? Is it an asset? Is it a product? Is it what the heck is whole life insurance?
And I've been in this business for a while, and as I've been keep studying the most misunderstood product in finance, cash value life insurance is the most misunderstood, and particularly whole life. And the more I began to dive into it and its different applications, how it can be used, I've determined that I'm going to reclassify it a little bit, and I'm going to use the term life insurance wealth contract, because it really is. And so as a wealth contract, it can either be a contract to store your wealth, or it can be a contract to replace wealth, or it can be a contract to bring in wealth to pay somebody else. Just depends on the application of how it's going to be used. But when I rephrase it, see, if I say it's life insurance, the first thing that most people think of is how cheap can I get it, or can I even qualify? We're not necessarily thinking about all the things it can really do. And so when I call it a life insurance wealth contract, being compliant, because I want to stay in compliance, and being able to show that it's something you want to build a value within, or use it to, as a problem-solving tool. I think it brings a different dynamic to how we can talk about this product. Most of the time, I think insurance agents, they go in, they do a needs analysis. They say, well, you can do term or you can do whole life. Let me tell you all the things that you can do with whole life. And then it blows up in their face like, well, why would I need all that? I just need a little bit of coverage in case, something happens to me. And so you have to come in from a different perspective. Which problems are you trying to solve that can be uniquely solved by using these tools? And that's the way to come into it. Not, hey, you need life insurance. Hey, how much do you want to pay me for it? That's really what it sounds like. Totally. From those that are not coming in the right way. And they're talking too soon about
so well said. I love where you're going with this right out of the gate. If we look at the average financial advisor in North America, 95% of them fail to earn a living within the first 2 or 3 years. And but it mirrors a lot of what you just said. How they're showing up in that very first meeting, talking about life insurance, talking about whole life insurance. Why is that? You and I are both advisors. We're in different countries. I'm successful as an advisor. You're successful as an advisor. What are we doing different that the other 95%? Because we need people to be successful as financial advisors. People need financial advice in this day and age more now than ever. Why aren't they successful?
I hate to say it, but I blame the training. The training is so mediocre, and I've experienced it, which is why I can say that. The training is bring whoever you know into the office or bring someone there for joint work. Let's do a fact find and let's see what we can do for them. And it seems more like throwing enough stuff against the wall and see what sticks. And you're expected to learn on the job while you're watching the senior agent if you're doing joint work. But there's really not a whole lot of great training. Now, when I made a transition years ago from being in a credit union environment where I was the investment advisor. And so there I was selling mutual funds, variable annuity contracts, and wealth management platforms. And I wanted to learn more about life insurance. And so I made a transition to go over to a mutual insurance company. I'm going to leave out the name because I'm going to make them sound pretty bad. And by the way, I know someone who's still in that agency 13 years later, and they're still just as bad. If it wasn't for bad training, they'd have no training.
It's like the lesser of two evils.
I went there. Yeah, well, and I'm not sure if I would want the bad training.
Bad training is arguably much worse than no training.
Yeah, absolutely. And so this particular agency, they had a schedule that Monday mornings was product training, and then Wednesday mornings was sales training. Okay. And so Monday morning, you go in there, and they say, here's all the things you could do with these contracts. Here's what you can do. You can structure it this way. You can do it this way. You can, it slices, it dices, it does your taxes, whatever they say. But no one ever explained why anybody would want to do this. And in my mind, and by the way, it's not like I was any slouch. I already had my Series 7, 66, obviously my insurance license, and I had already completed this course of study, the CHFC, Chartered Financial Consultant, so I'm no dummy. I'm like, show me how this can integrate with everything else anybody else is doing and why someone would want to do this. And essentially, why would someone want to overpay for their life insurance? Why would anybody in their right mind do that? And the hard part was that they told me, you can do all this, you can do this, you can do this. And I'm like, why would anybody want to do it? Show me the why. Everything else comes into play. I had to figure that out years later. Strangely enough, I finally... and I did some other courses, and there have been plenty of other people who can teach and train on some of these. And we might talk about some of those resources. But finally, I put together a checklist. I've got two checklists, two 24-point checklists. And I compare maximum funded life insurance to a 401k and IRA, a Roth IRA, a 529 plan, and an after-tax brokerage account. And I have it on 24 points. And I put it on one page so that I could see it better. And I color code it. I put it in red for the stuff that's not good, green for the stuff that is good, and yellow for the stuff that's okay. This is just what you need to know. It's neither good nor bad. It's just different. And I compared on all those areas. And on everything, life insurance wins out except for 2 points. The first point was that it's not tax deductible. Darn, we already know that. Unless you have it inside an IRS, a qualified plan from an employer, the business can do that. The other downside was that you can't deduct any losses. Well, that's also neither here nor there because there are no losses, at least according to the market, in a life insurance contract, unless it's a variable contract, and even then, that doesn't work for that anyway. And so I'm like, this looks pretty good, as long as we do it right for the client. Now I'm seeing why someone would want to do this, why someone would want to overpay for their life insurance, and the flexibilities and things, the things it will allow you to do. And I'm now in a study group, more or less, we're a lead group of agents. We call ourselves the Breakaway League. And what we've learned is that $1 can do the function of 4 if we have it in the right place. And so that's the neat thing about life insurance wealth contracts, is that having your money in the right place can give you far more empowerment than having your money in the wrong place.
Yeah. That's really...
Okay, that was
so powerful.
Good.
I mean, I love, okay. And I just want to circle back to something that David just said. It's vitally important. Is that it's very tangible. $1 can be $4. That is very real. And so that probably not in this episode. We're going to dive into the critical nature of how that actually works. We can get into that at a later time. You can connect with David to find out again what literally the math is on that. But mutual life insurance companies have been turning $1 into 4, we'll call it for this use case, for close to 250 years. In the United States and in Canada since 1847, we go international with this podcast. Now, if you look at an example that David pointed out, well, how does that happen? What the consistency of this? Let's take 2008. I mean, we know what the market did in 2008. It took back around 33 point whatever percent. And what did the life insurance companies? Market took back. The life insurance companies gave back. I think the dividend was on average around 7 or 8% that year. Right? Something
We're
like
in there,
that.
yeah.
So that people once we realize this, they go through this. It's too good to be true. Why are more people not doing it? And when the government catches up to it, are they going to shut it down because it is a loophole?
No. It is not a loophole. It is a provision in the tax code that the wealthy know how to exploit. That what we're trying to do is bring it to the rest of us so that we can exploit it too. Now, let's take 2008 as an example. Now, that year was the year I actually transitioned to that mutual insurance company. I still didn't know anything. And I'm looking at Bloomberg from September to November, watching the market do a free fall of 50%, 1,000-point drops, and this was from 14,000 that dropped all the way down to like 7,000 over a 2-month period. Just insane. Now, what are the talking pundits going to do on CNBC and all that stuff? They're going to say, if you've got money, you need to invest it. Who's got money? If you've got it all invested, you don't have anything else. But if we had cash value life insurance as a reserve, that's one way you can say, you know what, not only did I not lose money, now I could go and put it in the market and watch it grow over a period of time. That would have been a fantastic strategy quite frankly, if I knew about it. I would have been calling all my past clients saying, we need to take advantage of this. We're properly positioned to do so. So that's one area of your $1 turning into 4, because now you have it in reserve. I'm going to touch base on that one a little bit, because I'm not going to go into the depth that we were talking about last time. But $1 turning into 4, most people, if you think about envelope budgeting, you put money aside for retirement. Then you got money aside for college. You got money aside if you're a business owner for salaries. You got money aside for rent. You got aside for inventory, all that stuff. Well, imagine if you just had one pool of money that does all of that, and it funds your retirement in a way that you never thought was possible. That would be a way that $1 could do the function of 4 or more. Just for business owners, just doing a different way of thinking about your total financial situation and getting more synergy so that your $1 could do multiple things rather than $1 for this, $1 for this, $1 for this.
Very, very and asset approach. One of the biggest mistakes that people make, and I know you'll agree with this, is they look at a whole life insurance as a investment or the investment, and they're not looking at it as a place to leverage from, or a place, as you pointed out, to mitigate opportunity cost, right? And that's a real big one. I mean, most business owners, especially family moms and dads, if opportunity costs fell out of the sky, looking like a brick and hit them on the head, they probably wouldn't feel it because they're just so caught up in life, just running the kids to soccer practice, or to football or to baseball or whatever they do. Getting work, meals on the table. Oh, bam! The opportunity cost brick hit me. I don't know if I felt it. People that own whole life insurance, right, as an asset, and hold whole life insurance as an asset, is it fair to say that they're more acutely aware of the erosion of opportunity cost, or what opportunity cost might look like in their life?
Well, before you get to that point, the first hurdle is whole life insurance is expensive. You start thinking about the cost, right? There's a certain default mindset that we have to overcome, and sometimes we keep going backwards on it. And the fact is whole life insurance expensive? And the question that follows after that is short-term or long-term? Long-term, it's fantastic. Short-term, it stinks. Okay, because short-term, it's kind of like a brand new mortgage. You got these high payments. You're not building any equity. It's all interest. The good news is, at least with the mortgage, you can deduct it, depending. But so in the beginning of whole life, you're feeling the pain.
What is that?
It's over time.
What is that time? What is that time frame? I know that's what I love about talking to you, is that a lot of advisors and people that are whole life insurance experts, they kind of skirt around it, and it really drives me nuts. They don't. And what I love about you is you just take it head on. What is that time frame? What on average? And you can't. We're going to broad stroke this question. here, but
Well, you know what the answer is. The answer is
right.
it
Yeah, yeah,
depends, and
sure. But it could be so.
it always
You know,
just
I'm
depends. And so,
47 male. I'm healthy. I'm not rated, and I start tomorrow with a $10,000 annual premium. You know, when is it giving back more than I'm putting in? I mean, is it 10 years? Is it 5 years? Is it 3? Is it 20? I mean, just for viewers, just to give them kind of a very broad kind of.
well, and some of this is going to change a little bit because I've got a 5-year rule
Yeah.
that I created based on doing a whole bunch of
Yeah.
illustrations. My 5-year rule is this: in year 5, you should have at least 50% of the premiums you've paid in should be available as
Yeah.
cash values. And generally by year 10, you're going to have either almost or all of it, based on how
Yeah.
much you've put in, all of it available as available
Yeah.
cash values,
That's
generally speaking.
very
Now, different
conservative.
policies can have
Yeah,
different
that's very fair.
provisions. Yeah, that's on the
Yeah.
conservative side, but let's suppose that I wanted to overfund it up front so you can borrow against it in year 1. Well, that's kind of a different structure. That doesn't mean that the other structure is bad. It just means that it's a different way because we're looking for an immediate benefit. And actually, what's interesting with that one is that it suffers on the long-term side. It's kind of a little strange in how that works. But if we're looking at the long term, and our job as advisors is to set expectations. And I'd rather set the expectation that in 5 years, you're going to have about half of what you've put in. You're not going to find this fun the first couple of years. You might be kicking and screaming a little bit. You're like, what am I doing this for? And over time, you're going to love me. But in the meantime, you might not like me. Okay. And that depends on how the conversations are going and everything. So every client's going to be different.
So my next,
But the neat
Go
thing
ahead.
is,
Yeah. I was
go
going to
ahead.
say my next question, and we're going to get into the weeds a little bit, and this will be as deep into the weeds as we go with this. And we're talking about time frame. We're talking about two different styles of policy, more back end, front end, advantages short term, and more advantages long term. I mean, there's a whole death benefit conversation that we're not even really having here that exists and is relevant to the whole strategy. Obviously, it's like the cherry on the sundae. Hey,
Well, if I may, real quick, because
yeah,
I don't want
no,
to
you're
interrupt your
good.
question, but the biggest difference between term insurance and cash value, I mean, is all the benefits other than the death benefit. And so with term insurance, you can't come into the cash value conversation talking about the death benefit need and protection. We got to talk about all the other problems that whole life and other types of contracts can help you solve, but you can't approach it and then say, hey, it slices, it dices, it does your taxes, and wait, there's more. It doesn't come across the same way. So for advisors, if you say, well, I'm having a hard time, talking about whole life with my clients, all they want is term, that's because you set it up that way. And the only thing that term and whole life have in common is that death benefit. Everything else, again, think about whole life as that wealth contract, and how does that work in combination with everything else? Anyway,
Yeah,
please go
so
ahead.
exactly. And just to kind of follow that, and the question was kind of pointing at the idea of paid up additions. There's this little, on this illustration software, you're going to have this little button. And there's a little button you can click, and it'll be a paid up additions button or a rider that you can choose in a drop down menu. By doing that, it changes the whole dynamic of the contract, and
Yes.
it affects. And I like to provide value, and that's what we're doing for you right now. When I first got into this business, and when David first to find what we're giving you right now out, it took me literally. I probably had to knock on a dozen doors, and I even had people saying to me, Cole, yeah, we'll tell you that, but we're going to have to charge you $10,000 and how to build these contracts the right way. And here we are. Here's David and I just kind of handing it right over to you. So whether you're an advisor watching this or if you're a person that's potentially interested, this is David's and my gift to you. So David, paid up additions, take it away.
And like anything, it depends. But here's the thing is that it depends on how we're structuring the contract to solve the problem we're solving for. So for example, if I'm looking to have money be guaranteed to come in for a business buy sell, well, there's two ways I can do that. I can do that with a non-lapse guaranteed universal life contract, which are now more prevalent, although with the interest rate environment, they're kind of going
Yeah.
away a little bit. And so that's one solution versus a base whole life policy that can build a cash value over time. And what I would end up doing is let's map that out on an Excel spreadsheet and figure out which way would the client prefer. And with one of them, you could probably even use the policy values in the whole life to pay the premiums in the future. Um, and it just depends on what we're solving for. But on a minimum funded level, you're really not going to get a whole lot, and it's not very exciting. In fact, I've got an illustration that I was doing. I was comparing some different policies. You can structure these all the way you want. But with that policy, it took 22 years for it to break even. And what I mean by that is the cash value exceeded the premiums paid. 22 years. And so that's a minimum funded pay to age 100 policy. That particular company only had paid up additions for 15 years. This is not a policy you really wanted to build with. But that was a company I was dealing with a few years ago. Um, and so, but if you're solving for death benefit, that's the parameters you're looking for, especially for a business owner. Now, if we're looking to use a wealth contract to build up some values in there, the question then becomes how soon do we want those values to show up, and other needs and things. So if we're looking at a retirement scenario, that's when we can get kind of interesting. And now, granted, I am more of a fan of limited pay policies. Granted, every whole life policy can do what we call a reduced paid up, which means we can reduce that death benefit. No more premiums are ever due. No charges are due on the contract ever again, aside from if you borrow against it and you have your interest charges based on the size of the loan. That's it. Every contract can do that. Unfortunately, I don't want to necessarily trust the client to remember they can do that. Whenever I can try to take out the guesswork of making the plan work, that's what I really want to do. That's also one of the things, and we might talk about it later with IUL, because some of the funding, even if you're doing the funding right on IUL, you have to change the death benefit B back to A to contain the costs. And you know what? When's the client going to remember to do that? And will I be in the business long enough to remember to do that, or will I die and the client forgets to do that? Whatever is going to happen. Anything that could take the guesswork out. So I like limited pay whole life policies, which generally mean there's very few opportunities for paid up additions in there, because it's going to maximum fulfill that policy for 10 pay, 20 pay, or to age 65. Granted, we can massage it. Some companies allow a term rider, which increases the total death benefit, which means we can put in a higher amount. That's important because the IRS has its guidelines, and every company has their own interpretation of it, where you can fund these contracts up to a given maximum. And the question then becomes is, why would we want to do that? What's in it for the client, and how long are we going to do that? And what kind of policy structure are we going to do that with? Now, with that limited pay, I could put the term on there, but the term usually expires after 10 years. So you're not doing that for death benefit. You're only doing that to increase the amount you can put in. So you can take off that rider, and then you can still have all that death benefit, all that cash value that's been built up. Anyway, that was a long answer to some of that. A little bit in the weeds, but
it's good. And viewers, the industry is ready. I mean, if this conversation went that deep 2 or 3 years ago, we would lose people. But people are Googling whole life insurance. They are interested in whole life insurance, and they want to learn from the experts, with guys with an alphabet after your name. I got it written down here: CLU, CHFC, and RFC. We'll get into what all that means later. But there you have it. I mean, there's some life insurance speak from one of our nation's life insurance experts. So, and when we're talking life insurance here, in this case, we're talking whole life insurance. So let's get right into my absolute favorite conversation, which is IUL, VUL, any UL versus whole life. Both are permanent types of life insurance, but the two of them couldn't be any more different in so many different ways. And so I will just let you roll on the subject. Is one good? Is one bad? Is there a place? Is there a time? What do you think?
Well, let me start with my first belief that I have. And the belief that I have is that every legitimate product has a legitimate place where it can be used. Okay. There are some people that say, well, whole life has been a ripoff for 150 years. It shouldn't even be sold. Well, it's been around for 150 years and regulated by every state for a reason. All we have to do is figure out how it benefits the public and make sure we use it properly. That's why we have licenses, so we can be held accountable for the advice, the recommendations, and our actions. And so basically, having studied the history of the industry, You mentioned the letters after my name. I have a CLU. That was originally came about in 1927. Even back then, understanding life insurance was a
Chartered
problem.
life underwriter.
Okay, people didn't understand. Chartered life underwriter, and brought about by Dr. Solomon Huebner, a professor of economics at Wharton School, which was even around back then. And here's the thing: life insurance, up until I'm going to say the 70s or so, was primarily death benefit focused. The $1 Million Roundtable, which is a professional association for insurance professionals, they based their qualifications to join based on how much death benefit you had sold. So everything was death benefit focused. Now, in the 70s, what happened? We had rapid inflation, okay, especially the late 70s and such, and then we had computers. Now, what was one of the biggest complaints about whole life insurance back then was that, well, the interest rate stinks. They didn't necessarily know how to strategically use it back then. They're just looking at that rate of return and say,
That's a bad
stinks.
investment.
I could get It's a bad investment. That's right. And I could get 16% at the bank down the street in a CD. So, I mean, how do insurance companies compete? Well, with computers and with that kind of demand. And there's also another company that's saying, well, why are you buying whole life insurance? Buy term insurance and invest the difference. And quite frankly, back then, with that mentality, makes a lot of sense.
Geez, that's a hot topic right now. I'll leave that.
I'll leave
It's a
that one
huge
for
hot
now.
topic. And quite frankly, you know what? If all you're looking at is rate of return, they're going to be right. Now, but here's the thing. So anyway, insurance companies realize that we need agents to sell the products, and yet we're finding that agents don't want to sell it because of these objections and concerns in the marketplace in general. And so insurance companies first came out with universal life. Now, what is universal life? Well, my basic way is that if whole life is a bundled solution, universal life is unbundled. Let's make it a modern scenario. If we're watching a cooking show, this would not be a complete hamburger. This would be a deconstructed hamburger. Okay? That's what universal life is. And what you'll notice is that for anybody that looks at a universal life insurance illustration, you're going to see a whole bunch of columns on all the different expenses, different categories of expenses, and all these things. Because it's deconstructed, that means it requires more disclosure. Not that anybody understands any of that stuff. It just requires more disclosure.
If you're not a chef, I have never heard it put this way. This is brilliant. I have this conversation every day. This is brilliant. Now, if you have this deconstructed burger, God forbid it was a deconstructed, really something more complex culinary-wise than a burger. And now you're left to having to put it back together. Are you going to eat it in its individual parts, or do you want to have this juicy and God forbid, it might even cool down by the time. Oh, David, this is gold.
Well, but it's never sold as a deconstructed burger.
It's just
like
that way.
You get to pick however
they
you
tell
want.
You're getting a burger, and it comes all in its individual parts.
Well, that's how it works as far as expenses go. It's just deconstructed. So, but let me give you an actual financial example. If whole life insurance could be compared to a CD in the fact that if you go into a bank and you want a certificate of deposit, they're going to say, here's our terms, and 6 months you're going to get 1% if you're lucky. But are you going to get a disclosure? Are you going to get a prospectus saying, here's all the different expenses and things? No. And the reason is because it's bundled. Everything is bundled in. They factored in all their expenses. They say, here's your rate. Here's the term. Do you want it? Now, by contrast, if we look at a money market mutual fund, granted, this is an account that's not supposed to break the buck. You're not supposed to go below $1 per share. So it's going to be fairly safe. But yet, if you get a money market mutual fund, you're going to get a prospectus. And in that prospectus, it's going to be the fund's objectives and the expenses. Why is that? Because it's deconstructed. You're now considered an investor rather than a saver, and therefore you get more disclosure. Now, I'm not saying that universal life makes you an investor, but because it is deconstructed, we now have to give you disclosure on how everything that affects the policy. And generally, in the beginning, it sounded great. Now, I was not around back then, but I've seen plenty of recordings and such. So back then, what was the sales pitch? Get whole life at half price. Or we can double your death benefit for the same money, right? That was kind of the replacement strategy because we got this fantastic universal life policy. Well, the problem was that what were the interest rate assumptions being used back then? And you could say 9%, 10, 11, 12%. Crazy. By the way, one thing I learned from my CLU studies, because I just did that course of study earlier this year, they did not have regulations for insurance illustrations until 1997. So,
And they're
so
still
back then,
pushing the envelope today.
they're still pushing the envelope, yes. But at least back before, I used to blame agents, thinking that these agents were being sloppy and stuff. You know what? Now knowing that, no, it was the companies. So it's the companies that created a lot of this price war and all this stuff and smoke and mirrors, things
in their
like
illustration software, and this is one of the biggest criticisms I have of UL anything, is the fact that you can put some of those, you can illustrate at some of those rates. Those illustrations, those companies could scale that back, so you can't show 10, 12%, right? And they could do that.
And so today with the, I think it's AG 49. I think that's the regulation code on illustration. So they have a certain parameter algorithm, whatever it is, that shows that you can't illustrate higher than a certain amount each and every year for 50 years of the illustration. That's a long time. And the thing is that for IUL, it's not going to perform that way. And the thing is that IUL is a concept, and it's a great concept. I like it, except the fact that there's some issues. And so here's the thing. This is from the American College. This is the individual life insurance course, which I didn't learn a whole lot out of it. Got to admit, I took it because I wanted credit for everything I learned before. So they gave me my CLU. I took that course, got an A. I studied for less than 3 weeks. It was pretty easy. Now, here's the thing. The universal life insurance is a bucket, and this bucket has plenty of holes in it. And so you got to fund the bucket. But keep in mind, now looking here at this warning, if cash drops too low to pay fees and mortality costs for the next 60 days, the policy will lapse. So that's your first warning. So that's just right now. You got to overfund that thing to properly fund it. Now, we have different levels of funding, and target premium does not guarantee against the policy being lapsed. Now, that's why you got to fund it at least to target so that the illustration will let the policy stay in force. That doesn't mean the policy will stay in force. And so we have this, so you have your policy expenses and we have our mortality cost. I'll get to that in a second. But it's based on the current interest rate, which is a guarantee plus any excess. The excess could be any indexed return based on how you allocate within the policy. Now, the problem is up front, this looks pretty good. But over time, remember we got these holes in there? Well, that hole, think of it like a drill bit. And if it starts off with a 1/16 inch drill bit, watch it grow to a 1/4 inch drill bit, watch it go to a 1/2 inch drill bit, then to a full inch. That's what these increasing mortality costs do. And so when I compare how I'm using whole life insurance to how I had to have to do the same thing with universal life insurance, to me, universal life might make sense for a younger person. Someone who is younger, who wants to build up this policy, and let's go ahead and get that indexed interest, but I wouldn't want to keep this policy for the rest of my life. At some point, I would want to transfer these values, we call it a 1035 exchange, and move it to another policy where I can make sure I keep what I've accumulated. Because otherwise, it's just all going to go into all these policy expenses and mortality costs over time, and you might not have that. It might not last as long as you do. And I want the policy to last. That's what I got it for. But up front, I mean, let's suppose you're age 30 to 45, this wouldn't be necessarily a bad policy to go with, knowing that we would want to move this policy to something else much later down the road, because I don't want those policy costs, those mortality costs, to eat away what you've already built. So that's why I look at it. It's a permanent policy. Well, I really can't call it permanent. It's a cash value policy. I wouldn't really want to call it permanent policy. A whole life policy, as long as you pay your premiums, that's permanent.
I love this slide, and I think it just really very clearly identifies. I love the analogy of the drill bit. I love the the warning in yellow. It says a lot. You can use analogies of whole life versus UL in terms of driving a Ferrari, or driving a race car, or driving a race car, or driving an F-150. If you drive a race car the wrong way, it's likely going to let you down. And I consider these UL policies. There is a time and a place where they need a lot of maintenance, and you need a pit crew, keeping an eye on them every single minute of the day. And if I don't personally own any, I own 11.
I wouldn't go that far, but they should be reviewed at least annually.
Yeah.
At a minimum. Now, granted, there's also another variation of this called a variable universal life. And here's the problem with variable is that it's all invested in the market. So depending on how, and by the way, usually it's a limited amount of allocation. So you either have to go with their model portfolios or you can choose within the mutual funds they make available, mutual fund sub-accounts. That's the technical term. Then the problem is that as you get older, let's suppose 2008 happens when you're 65 with that kind of a policy. Well, your cash value went down 50%. What happens the next year, essentially, when those mortality costs are being billed against an already deflated balance? Now, the mortality cost is on that difference between the death benefit and your cash values. That difference has widened even further. And that's why I don't like it, because you're increasing that, which means it's increasing the cost per dollar of the pure insurance. That is a trap. And so I'm very cautious of it. At least IUL has solved that particular issue. Because if the value goes down, it's only because of expenses, not because of the market.
Right.
So I credit IUL for that protection there. But it's still not
the
perfect,
indexing does
because those mortality costs are still
correct.
gonna
The indexing does give a little more security as it would versus the variability of VUL for sure, which is probably more the analogy of the race car versus the F-150 in that case. But any way you want to look at it, for me personally, I own 11 whole life insurance policies. I don't own any VULs or IULs, and I just like to be able to spend time with you and not worry about what the market's doing and what that yellow box that you showed. Yeah, I don't want to worry about that yellow box, because I don't have to.
Yeah, exactly. And of course, since we are talking to advisors and such, generally, in order to sell a variable contract, you have to have FINRA securities licenses in most cases. And quite frankly, I don't have those anymore. I don't want them anymore. I don't like the overbearing compliance requirements. It's not that I'm a bad compliance risk. It's just that I don't need Big Brother, who has less acumen than I do, to try to tell me how to market this stuff. Like, no, get off my back. I don't need it. I do have a Series 65 registration, and so I can do fee-based asset management. And if there's fee-based contracts like this, I could offer them. But then I'm like, why? I don't see necessarily the need or the advantage for doing that.
Which is
I'd rather just say
a great segue, David, to let's go. Well, the viewers, let's go easy on their brain a little bit. You did a great job up until now. You hung in there with the big gun here. CLU talk. Now we're going to switch gears and we're going to talk about something fun. We're going to talk. That was the finance piece, and I promised you some fun. We're going to save the best to last. So here we go. We are going to talk about, another F word. Let's talk about Facebook. Here we go.
Boy.
Let's talk. Now you're going to think, well, I got Cole. You're interviewing this guy. This alphabet is CLU. He's dropping science on life insurance products. But now, how I met David. Now this is supposed to show you how popular whole life insurance is. David is the admin of, I think, the best Facebook group on specifically whole life. What's the name of it, David, again?
I actually just updated the name. It's now called Advanced Whole Life Insurance Agent Discussions.
Advanced. Okay, well, that pretty much Advanced Whole Life. Now, how many members are there?
In that group, about 820.
Okay, that's a very robust group, and that's how I found David. There is a daily, all hours of the day flow, dialogue, conversation. Sometimes it gets heated. How do you? And you're all
well. Actually, if I may, the whole life group is a smaller subset of that big group that you're talking about. Now, the big group is just life insurance agent discussion group, and I've got about 13,000 members in there. So I've got a subsection of just focused whole life discussion group. In that smaller group, I've got some other CLUs. I've got a couple of people from the American College. I've got Tom Hegna in there. Van Miller's showed up a couple of times. I've got a lot of really neat industry people, and they bring their A game, and sometimes we get into it, and it gets pretty in depth.
It does,
in there.
and it blew my. So the whole life discussion group is the one with almost 14,000 members, and then you have this.
No, the life insurance. It's a general group. That one has 13,000. The other one is so much smaller, but more focused. I created that one to be more focused for that discussion. But both are good, because anybody that wants to ask, well, where do I get leads? Or how do I learn about this stuff? Go to the big group. The smaller group is far more focused. And I've got some people, they go into the weeds, and it's fun. I learned some things in there too.
What do you, this is exciting stuff. I mean, people are advisors. I mean, there's let's talk about leads, for example. I'm in the business, you're in the business. I can't turn on my phone or my computer without getting a shot across the bow of some spam-ishy kind of, here's another digital marketing agency promising me, I'm going to have 700 people in your Zoom room, and all you have to do is pay me $70 per lead, and I guarantee you millions of dollars. It's like, stop the madness, So how do you filter all this? How do you weed out the noise? How have you kept this group that you're managing so pure? And I'll tell you, you do a heck of a job with it. I mean, you do not put up with any BS in that group, and you keep it tight, and it's focused, and there's value there. So how do you do it?
I appreciate that. Well, first of all, I've got an administration team, because I can't handle it all the time. That group that big, it becomes a full-time job of itself. So I've got a team of 5 admins, and they've all been great. We all get along well. We have the right kind of vision, and they help moderate that. This week, I think I'm going to have another 200 members just joining this week. I can't process all those applications coming in. It's so many. But the main thing about that group is that, there's people asking, where do I get leads and such. Now, for me personally, I've discovered that for me, I'm not you say I'm good with social media. I'm good with bringing advisors together for social media. I get a lot of contact from other advisors. The public, not so much. I could put out there a great, I think, ad copy, and I'll get crickets. So I'm really good with advisors. I love coaching, but quite frankly, advertising or marketing on Facebook, it hasn't done anything for me other than if someone was to search for my name. Let's suppose I actually call somebody and we set up an appointment. I actually tell them, search for my name. You'll find me on social media. You'll find me on Facebook, LinkedIn, and Instagram. And go to my website. I got a blog there. If anything, you might be able to figure out that I might know a couple of things that I might know what I'm talking about. That's the whole thing. That's my entire social media real campaign, is that I just want you to know that I might know a thing or two. Let's figure out if I can help you. That's kind of it for the public. But the bigger life insurance agent discussion group started about 3 years ago, maybe 4 now. And it started off with the insurance forums. And I don't know if you're familiar with that forum. It's a separate website. And so the founder decided he wanted to do a Facebook group. And I was like one of the first 20 to go ahead and just join in. I thought, well, okay, we'll just see what happens here. And they asked me, David, would you like to moderate? I'm like, okay, I'll moderate, but I want to build this group for me, and I want to build this group as though it was mine, and I want to make it a little bit looser than the forum. The forum has no spam, no promotions of any kind until you prove yourself, all this stuff. I'm like, look, I want to hear what people have got going on. I just want to make sure it's on topic and that no one's doing recruiting. But at the same time, I'm like, I want to bring about the best minds I've ever heard speak to come into this group. And so I've got plenty of people that are MDRT top of the table. Now, if anybody that's not familiar with that, that means they're generally doing $1 million or more of commission business each year. And I've become friends with them, which is also amazing. We've spent time together. And believe me, I needed this more than anybody else, but I'm like, I've heard all these people, let's get them into a room, let's see how we can all interact. And so I've got Tom Hagna in there, and we've talked a number of times. I've got Van Miller, Jim Ruda, Tom Love, who I've been learning from. I've got the guys for the Insurance Pro Shop that are in there. I've got so many people, and the whole goal was, how can we get all these people to interact and such? Now, granted, with 13,000, it's a little bit harder to get the specialized voices to show up on occasion. Sometimes I have to tag them into a post and say, well, this guy has said this, here's his video. And then when I tag them, they'll come in and they'll add more, which is fantastic.
I just want to highlight.
I'll give you an
I want to
example of
highlight
that.
really quickly what it is that you're doing, and for you watching this right now, David is talking about something very simple. He's talking about adding value. He's talking about basically creating value. Gary Vee talks about this all the time. I mean, if you are showing up in any social media and you're not adding value, if you're asking for deposits into your life and you're not making deposits into someone else's life, when it comes time for you to ask, they're not going to give back because you haven't made deposits. That's what David's doing. If you can really think about what he's done, is he's created value, right? And that value that's why he's here today. And it's likely that if you think really anecdotally using a use case, what's happening is that we're going to send this video across our network, which is pretty big. People are going to see David. They're going to say, "Oh, that guy knows what he's talking about." I'm going to call him up and ask him for some advice, and he'll probably get some business out of this. And now, if David didn't create he created value for me through moderating and taking ownership and holding his Facebook groups, in this case, to a high standard, and that high standard was value. This meeting today wouldn't be happening, and the leads that come from this for David wouldn't also happen. So just put yourself out there and hold yourself accountable to creating value. Sorry, I had to throw that in there because you're just.
I love that. But I got to throw this in there. My grandmother's name was Karma. and our dog's name was Murphy. So look, I had it on both ends. So I've got Murphy's Law and Karma always comes around. So
you're not serious.
Gotta love that. But it's so neat that we do keep it rather tight. Although what I want is that in that group, I want everybody asking questions. What are they having trouble with now? And part of my goal in that group is I want to elevate the industry where I can. But at the same time, I'm not going to put up with any bull either. So the rules are essentially we're not spamming people to recruit them into other people's groups. And I don't want anybody abusing the group membership by private messaging saying, hey, you're open to a new opportunity, which doesn't work anyway. But then I just don't want anybody abusing
How do you
group
manage
membership.
all of that? How do you police that?
For private messaging, people just have to report it to the admins, and we take care of it. One report, they're gone, because I don't put up with it. We've got so much value in there. The neat thing is we've got so many different settings now that we've gotten the group this big. I've got so many files. I got over 50 different PDF files in there. Some of them are textbooks. I want people who don't know much about life insurance, America, to learn a few things about life insurance. And so I've got the whole textbook in there. In fact, it was nice when Dr. Michael Finca actually, said, "Hey, that's great that you're promoting the textbooks in there." I'm like, "Hey, I've got the American College on my back here. This is good." I've also got guides. So if someone is brand new, I have guide number 1 that starts off with, "I just got my license. Now what?" And I go through how you got to make this a business decision, not a job decision. This industry works very differently. I got so many different other guides I've put in there. I've also now got a setting called Group Experts, and I got about 22 different people that I've designated as Group Experts. One of them is a Primerica agent, by the way. He's been with that company for 25 years and has a sound mind for it, and I like that. And so I want to encourage some of that. Every once in a while, look, unfortunately, Primerica, and if you go to my YouTube channel, I've got a love-hate relationship with Primerica. I've got 2 different videos on that. And I think
I'm the same way with World Financial Group, and I have no problem. I talk about it, and actually, even at Life 180, on our channel that this is on, we have a lot of some of our most viewed videos are our opinions on WFG. So,
sure. And the only thing is that Primerica as a company culture. Now, granted, I know about 5 Primerica reps that are very professional, and I love getting along with them. But the rest of them seem to be industry trolls. They seem to be conditioned to be a troll against a professional and not knowing. Now, granted, they do a service. They help sharpen the rest of the industry because the industry used to be whole life insurance was the way you go, and then term was the backup. Now it's switched completely around. Primerica was an industry disruptor, and you can't help but admire that, which means the rest of us have to get better, which is good. So I admire that aspect, but at the same time, don't think you can replace my business. You're playing tic-tac-toe, I'm playing chess. you can't even comprehend why I think whole life insurance is better than what you're recommending. You don't even know the parameters to evaluate it.
Wow. Okay.
And so some of them I do the slap down and such, and then finally I just like, look, I have no time for this. I have a rule in my group: no trolls are allowed. And a troll is defined as someone who just wants to hear themselves talk. They're not open to learning anything, and those people I got to kick out because they annoy the heck out of me.
When your group gets to
And so,
25 or 50,000 people, you got to have at some point the David H. Kinder SmackDown T-shirt or something. I mean, really.
well, what was it that Grant Cardone says? You got to have haters, and if you don't have haters, what are you doing?
Really, you're not trying
hard
enough, or you're not. Your success is measured by how much hate that you have to process.
Yeah, I need a little more. I need a little more. But the neat thing is, on Facebook, you can block people. That's
Yeah.
the fun part. So even if they hate me, I'm like, look, I don't have to see you again for the rest of my life. You're blocked.
Well,
I'm gone. And you're kicked out of my group. I think
You've done a heck of
the
a
group
job
is a
with
privilege.
it, keeping it pure and keeping it valuable. So we're going to tidy this up today by asking David one last question, and we're going. So this is kind of a quick recap. We got deep into UL and whole life. We talked about the industry. We talked about social media. I mean, there's been a ton of value here. David, anything before we give the viewers their time back? And I know that anyone watching this is going to obviously take a look at all of the links below in the show notes. We're going to have tons of content, ways to connect with David. We're going to strip through this and extract any kind of pointed links or references that David has made, obviously, in it. So just before we give the viewers their time back, closing thoughts, anything that you wanted to just table before we get out of here?
Sure. And so here's what my last thoughts are: is that we need to focus the conversation on the problems that life insurance can solve. Once we understand the problems, the solution becomes easier. In fact, the solution should almost be irrelevant once the problem is clear enough. And often, when someone has an objection to the solution, they lost sight of the problem that we're solving. That's one big thing. And so we need to keep the focus on the problems that we're solving, because the solution is pretty much irrelevant.
That is amazing that
as
you
long
said
as,
that.
of course,
I just have to kind of weigh in, and maybe we'll just take a couple seconds here and talk about this a little bit. I mean, so I've studied at the Nelson. I'm a member of the Nelson Nash Institute. I'm an infinite banking practitioner. I mean, I've kind of gone in that direction. I mean, there's different approaches to whole life insurance. That's one that I admire. I take value from that. There's different approaches that I take. The more mathematical approach, the CLU approach to it. I get it all. But that's the one thing that in any of Nelson's literature he would always talk about. He would describe it exactly that way. The solution to the problem. If you can't see the problem, you'll never be able to see the solution. That is really interesting. Now, I'm just curious. Was that quote that you just dropped there, that little bit of that nugget that you just dropped there, was that extracted from Nelson Nash or the infinite banking world, or was that just a synchronistic kind of idea?
Well, a common phrase out there is that there's no such thing as a new idea. So everything gets stolen, but the question is, how do we massage it to make it clear? Because we're really in the communication and trust business. And so the thing is that now, as part of the Breakaway League, which I'm a part of with Thomas Love and a number of people, we got about 50 people nationwide. We have a few CPAs, we have a couple of attorneys and such. They're all doing this strategy with people. And the thing is that what we're taught to do is we share an explanation of services. And my explanation of services is this. I want to teach the American public how financial planning is going to fail them. Because what they don't realize is that in California, if you retire successfully in California, you're going to be paid sixth in line out of your own money. Sixth. While the banks, the financial institutions, Wall Street, and the IRS, not only are they ahead of you in that line, but they already have their hands in your money before you do. So I want to teach the American public how that's happened, why that is, and how we can turn it completely around using the tax code, so we can help you be the primary beneficiary of your life's work and of your financial retirement planning. And if we do this right, we can even do it in such a way that you don't even have to file a tax return in retirement using the tax code. Now, as an example, I helped my parents retire last year, And, it was because of COVID, their business suffered, and so they were essentially forced into a slightly early retirement. I was able to show them how they could spend $460,000 in retirement as though it was over $1.7 million because of understanding the tax code. Now, if I could do that for them, would you like to see what that might look like for you?
Absolutely.
That's my invitation.
And I would invite you to check out, again, Dynamic Advanced Wealth. There'll be links below. David Kinder, you don't have to Google very hard to find him. You'll definitely find him in Facebook. Don't get the Smackdown, the David Kinder Smackdown, though. So behave in his group and make sure you add value like he has. I'm Cole. This is Life 180. Thank you, David, for a wonderful, inspired hour. I've never had so much fun and talked so much finance. Thank you, and we will see you soon.
Awesome. Appreciate it, Cole. I enjoyed it.